Thanks for joining us on Power Lunch. This is Bloomberg Quint and I'm Ira Dugal. Let's get you the headlines. Indian markets trade flat ahead of the IIP and CPI numbers. Nifty trades below the 10,900 mark, dragged down by weakness in IT stocks. Government plans to divest up to 3% stake in Axis Bank that it holds through SUTI. The offer for sale will be at a 3% discount to Monday's closing price. The NCLAT has directed 22 domestic and 133 offshore subsidiaries of IL&FS to service their operational and financial debt obligations. And three Nifty companies, Hindalco, Coal India and Sun Pharma, will report earnings today. All right, let's take a look at how markets are faring first. Yatin Mota is here with us.
Afternoon, Ira. And if you look at the Nifty, we are trading almost flat throughout the day. What's the advanced decline ratio looking like? That's almost 1:1. The market is doing nothing in trade today. However, if you look at the metals pack, that has been quite active. JSW Steel, Vedanta, Tata Steel, these are the top three gainers on the Nifty, gaining anywhere between 2.5% to 4.5%. So good gains coming in as far as the entire metal pack is concerned. What's also doing well is the oil and gas pack. So we have BPCL, HPCL, ONGC. All of these stocks doing relatively well versus the other stocks like HCL Tech and Infosys, which are dragging down the Nifty, 2% down for each of them. Also, Hero MotoCorp and Eicher Motors, these are the two-wheeler companies which are in focus. Both of them are trading with marginal losses in trade. Hero Moto extending the losses 1.5% down for that one. What's also doing well in trade relatively is Axis Bank. Remember yesterday there was an announcement relating to the divestment of SUTI's stake in Axis Bank at a 3% discount. That was the maximum discount offered, and despite that the stock is gaining momentum, almost touching the day's high few minutes back. Also Reliance Communication, Reliance Power and Reliance Infra are something to focus on. All of these stocks are down on huge volumes, mind you. Reliance Infra also down another 4.5% in trade.
Yatin, thanks so much for that. Let's talk currency. The rupee extended its gains for a sixth straight day to trade around 70.80 against the US dollar. If you look at a 5-day performance of the Indian currency, we are the best performing in Asia despite the strength in the dollar, which has persisted. Let's talk both dollar and rupee. Rohit Garg, Director of Asia Forex and Rates at Bank of America Merrill Lynch, joining us on the phone line. Rohit, afternoon. Thanks so much for joining us. I'll start with the Indian currency first. What's at play there? It looks like there is some sort of strength coming back, perhaps on the back of flows into equity markets and in the last couple of days into debt markets as well.
Yes, hi. I think, ever since we've got sort of a favorable budget for domestic consumption, and ever since RBI also, complemented that thing through a rate cut as well as, sounding dovish on future policy actions, I do think we are receiving quite a bit of portfolio inflows both on the equity as well as debt side, which has generally helped INR. What's also helped INR is the fact that oil has generally remained quite soft. It's stabilized quite a bit, unlike expectations that we could have, gone higher in oil, but that hasn't materialized. So in general, I would say the backdrop has become a bit more favorable for INR, at least in the short term.
Rohit, a slightly sort of marginal factor, but in the policy, the RBI had removed that 20% concentration limit on FII holding in corporate debt. I remember when it was announced, there was a little bit of concern about what the implication of that would be for flows into the debt markets. Could that on the margin also be a factor?
That could be a factor, but I think what's more important to actually see is that in general, RBI is easing the restrictions, which means that in general it is encouraging more portfolio inflows. So that is what I would actually read it as it's making it easier for offshore market participants to access the Indian debt market.
All right. Rohit, a word on the dollar as well. Looks like there is some strength which is persisting. How do you see the dollar strength?
Yes, lately we have seen a bit of dollar strength, and that's probably on the back of I would say renewed optimism around the fact that maybe we will avert the government shutdown in US, and also probably on the back of I would say a bit more softer data that we have been getting out of EU in general, which has resulted in the other G10 central banks, the likes like RBA, BOE sounding dovish. So I guess it's really been a factor of these two. and potentially also renewed optimism around trade negotiations between U.S. and China that has resulted in broad-based dollar appreciation, I would say.
What are your near-term targets on the dollar, but also on the Indian rupee, if you can share?
Sure. So as far as dollar INR is concerned, we are trading from the bullish side on INR, at least in the short term, for the next 1 month. But as we do approach the elections, we are a bit more cautious around that, simply because the political uncertainty is going to be incredibly high. So overall, given the fact that we still expect dollar CNY to actually go to 7 somewhere around mid-year, we are still penciling dollar INR to actually go to around 75 levels. But then as we progress into the year, by year end, we do expect a bit more softness in the dollar, and that's why we expect INR to actually strengthen to 72 levels. So I think over here, what I would actually generally, focus on is that at least in the second half of the year, we are still penciling in a bit of INR appreciation post-elections.
All right, Rohit, always good to talk to you. Thanks so much for a quick view there on the currency markets. Let's move on. 2 Indian mutual funds have seen their assets plunge by more than half in the December quarter as investors pared their exposure to NBFC debt. Nupur Acharya, Bloomberg News, joins us with more. Nupur, 2 funds from 2 beleaguered groups.
Yeah, that's the story in a nutshell. You have India Bulls AMC on one hand and DHFL Pramerica. And the main concern is not with anything to do with the funds, it's more to do with the parentage. So institutional investors specifically have become pretty wary of funds who have a large exposure to the debt issued by these NBFCs, or even a high exposure to an NBFC paper per se. So like I'll give you an example. In the case of DHFL Pramerica, and the ultra short-term fund has an exposure of 34% to the debt paper issued by the parent, Diwan Housing Finance Corporation Limited. So as you see these companies coming into the limelight, there is uncertainty around how they will move forward. There is a sense of risk aversion coming, and which we have seen in how the funds have saw that kind of exit.
You spoke to the fund managers, I noticed in your story. What was their view?
So they do admit that their times have been tough. Like DHFL Pramerica says that they have been more skewed towards the debt market, which has been the results. But they feel that things are now coming back to normal. India Bulls AMC also says that they are seeing funds coming back into their liquid funds, and they hope that normalcy will come in a couple of months.
Nupur, thanks so much for that. The government is looking to sell up to 3% stake in Axis Bank that it holds through Suti. The sale will fetch the exchequer about 5,500 crore and take the government a little bit closer to meeting its divestment target for the current financial year. Nikunjori reports.
The government will come up with an offer for sale to divest its stake held in Axis Bank through Suti Holdings. The government plans to sell up to 3% of its stake in Axis Bank, out of which 1% would be the green shoe option. The stake sale will help the government in garnering a little over than 5,300 crore rupees in the current financial year, and this stake sale comes at a time when the government's divestment receipts have been dismal, and despite this the government has not revised its divestment target downwards from 80,000 crore rupees. This means that the government will have to sell its stake held in companies worth 45,000 crore rupees in the next 1.5 months. Now more stake sales could be expected. The government could sell its stake held through Suti Holdings, and a major chunk of the divestment target now would come through the acquisition in the public sector enterprises space, like PFC acquiring government stake in another public sector company, REC, which is expected to fetch the government over 14 to 15,000 crore rupees in the current financial year.
State Bank of India has not been very successful in its attempt to exit its Essar Steel exposure. The state-owned lender has found only one taker, that too for a small portion of the loans on sale. Vishnath Nair joins us with the details. Vishnath.
Right, Ira. So the sale process that started mid-January was supposed to end on Monday. According to what our sources are telling us, at this point in time, only Bank of America, Merrill Lynch was the only bidder to have submitted a final binding bid for Essar Steel loans, and that too for a small portion of about 1,900 crore. Remember, the outstanding loans are more than 15,000 crore in this case. So against the 1,900 crore loan that they've bid for, Bank of America is willing to pay up to 70%, 75% in cash upfront, so as to buy the loan. Now, it's important to notice because it was the first time, probably in a very long time, that a bank had put up its large exposure of more than 15,000 crore on the block to for sale to ARCs, NBFCs, banks, whoever was interested at this point in time. And to see that SBI has not been successful, according to what people are telling us, is that markets did not have the kind of appetite for that big a loan amount, and possibly there would have to be more tranches of the sale process to be conducted, so that SBI could recover some money from these loan amounts. But SBI is also dealing with a deadline for this whole matter. There is a deadline of 31st of March 2019, before which SBI has to either sell this asset or fully provide for whatever is left on their books, because the RBI has been giving them some special dispensations for the last 2 quarters of this financial year. So before March, if they're not able to sell these loans, then of course the provisioning hit will come in. They have about 50% of provisions in this case. They would have to provide the whole amount if some of the amount is left on their books at the end of the financial year.
Right, Vishnu, thanks so much for that. Meanwhile, the National Company Law Appellate Tribunal has granted the Ahmedabad NCLT more time in the SR Steel insolvency case. The NCLT will decide on the ArcelorMittal 42,000 crore bid by the 19th of February, and the Appellate Tribunal will subsequently hear the case on the 28th of February. The Company Law Appellate Tribunal has lifted the debt moratorium on the healthier of the IL&FS subsidiaries. This allows ring-fenced special purpose vehicles, or some of them, to service their debt obligations on schedule, addresses investor concerns of a spillover as well. Ridhima Saxena joins us with the details. Ridhima.
Yes, so the appellate court has lifted the debt moratorium on 22 domestic companies of IL&FS and 133 offshore companies of IL&FS, and these 22 companies that have been classified as green are able to pay all their operational and financial debt obligations, which they will start doing so as per the scheduled debt repayment. There are 10 companies that have been classified as amber, which means that they are able to pay all their operational debt, and as well as the debt to senior secured financial creditors. And there are 38 companies that are marked as red, which are not able to pay any of their debt obligations. So the moratorium stays on the companies classified under the amber and red categories, but these companies will have to make necessary payments to keep their business afloat and to maintain the going concern status. Additionally, the Ministry of Corporate Affairs is yet to categorize 100 other domestic subsidiaries and joint controlled companies of IL&FS within these 3 baskets. Apart from that, the resolution process of the 302 subsidiaries and joint controlled companies will now be overseen by a retired judge of Supreme Court, Justice G.K. Jain, who NCLT had asked to be brought on board in its February 4th order.
All right, Ridhima, thanks so much. And for those interested in the names of those individual companies, do go to BloombergQuint.com. Let's move on. Lower crude prices may be great news for consumers, but it throws oil marketing companies' inventory management haywire. All 3 state-run fuel retailers have posted a sharp rise in their inventory losses in the last quarter. Somit Sarkar tells us why. Somit.
So if you see, the state-owned oil marketing companies suffered massive inventory losses in the 3rd quarter of financial year 2019 because of the fall in sharp crude prices. Now, if you see, in the 3rd quarter, the inventory losses amount was close to 17,500 crore rupees, and that is because in 1 quarter itself, Brent crude prices fell from $86.3 per barrel to $50.5 per barrel. Now, because of this massive inventory loss of close to 17,500 crore rupees, the EBITDA margins of all these oil marketing companies also fell sharply in this quarter. Now, Indian Oil Corporation and HPCL's EBITDA margins were close to 2.6% and 1.3%, which was the lowest in last 3 years, while that of BPCL slipped to 0.9%, which was the lowest in last 5 years because of this inventory losses. However, adjusting for this inventory loss amount, the operating performance of this oil marketing companies was not that bad. Now, if you see the actual EBITDA of all the 3 oil marketing companies, that is Indian Oil Corporation, HPCL and BPCL, now that declined in the range of around 47 to 70%. Now, this is the actual EBITDA, but if you adjust the inventory amount of this oil marketing companies, then the adjusted EBITDA of this oil marketing companies would have been higher by around 4 to 6 times compared to last quarter if you would have adjusted the inventory amount for this oil marketing companies.
How is the 4th quarter turning out to be?
Now, the fourth quarter, in this fourth quarter, we have seen the crude prices remain more or less stable, which means that unlike the third quarter, fourth quarter would not, the oil marketing companies would not suffer higher inventory losses in the ongoing quarter. Along with that, the marketing segment performance has also been good because the gross marketing margin earned by these oil marketing companies on sale of every liter of petrol and diesel that has average around 6 rupees per litre, which is the highest at least since the first quarter of financial year 2016. Now, because of this higher gross marketing margins, the marketing segment of this, all the three oil marketing companies will be boosted in the fourth quarter of financial year 2019. Moreover, this trend of higher gross marketing margin for these oil marketing companies is expected to last throughout the fourth quarter of financial year 2019, because in the first quarter of financial year 2020, the general election period will come in, because of which the margins could weigh down for this oil marketing company. So the possibility of higher gross marketing margin in the current ongoing quarter is expected to continue for these oil marketing companies. However, on the refining side, if you see the benchmark, that is the Singapore gross refining margin, that has slipped to around $2.4 per barrel, which is the lowest in at least the last 8 years. Now, because of this lower gross refining margin, the refining segment of these oil marketing companies would be under pressure, because if you see this GRMs have been falling continuously, the benchmark GRMs has been falling continuously, and a fall in GRM means that they will earn lesser on every barrel of crude that they process, and that's the reason the refining segment would be under pressure for oil marketing companies in the fourth quarter of financial year 2019.
All right, Somit, thanks so much for that. Wedding season demand has led to a surge in gold imports in India. Imports jumped over 60% despite local prices trading near record highs. I think that's 60% in the month of January. But Swansea Alfonso of Bloomberg News is here with us with the details. Swansea, what's going on?
Yes, we have seen a kind of recovery in January because last year was a poor year in terms of demand. So in January we saw imports rise 60%. This because jewelers are restocking for the wedding season that's starting this month, and then you have certain auspicious days coming up in May as well. I mean, the general expectation is that, demand could increase this year, it being an election year, so there'll be higher spending. Plus, you've seen in the budget the government allocating cash handouts to farmers, which could improve the rural liquidity, which is where bulk of the gold demand comes in from.
And the price factor is always on the margin in the case of India.
That's going to be the biggest risk actually to this demand prospects. I mean, India is a very highly price-sensitive market, so you could see some, hesitation from buyers, and there won't be an aggressive move to buy gold as such. But, yeah.
All right, Swansea, thanks so much for that. Indians secured under the government's Ayushman Bharat scheme are using the insurance cover for specialized medical care treatment. More than 3/4 of the claims were for cancer and heart diseases. Ridhima Saxena joins us with the data. Ridhima, what have you found in the data?
That's absolutely correct, because the most utilized packages under the scheme were medical oncology and radiation oncology, which was closely followed by cardiology and orthopedic treatments. And then a close fourth was urology, which especially dialysis, which was utilized the most by the beneficiaries of Prime Minister's free health insurance scheme that looks to cover nearly 40% of the population in the country. While patients were accessing tertiary care treatments, there are concerns over availability of specialized hospitals as well as doctors in the country, and this problem is compounded by the availability of private hospitals, which for now are 56% in the scheme. So the scheme is run largely by private hospitals, which cover more than half of the scheme and run the scheme by them. But there are concerns that private hospitals may opt out of the scheme if the rates are not revised, as Indian Medical Association has been lobbying to increase the rates and has called it unviable and unscientific. Now, within this fiscal year, the budget was increased nearly 3 times for Ayushman Bharat to 6,400 crore, but the individual rates of the packages, and there are 1,354 packages that are there under the scheme, they still remain unchanged. We reached out to National Health Authority, which is the implementing body for Ayushman Bharat, and they could not give us a timeline as to when the rates will be revised, and in fact a technical advisory committee has not even been formed yet. However, they did indicate that it is more likely that rates will be revised for the most utilized, in this case the tertiary care packages, before other rates are revised for the other packages.
All right, Ridhima, thanks so much. That's an important story there. The Parliament panel on information technology has issued a fresh summons to Twitter CEO Jack Dorsey after he failed to respond to the first one. Dorsey has been asked to appear before the panel on the 25th of February. This comes in the backdrop of concerns over data privacy and the possibility that social media could be used to interfere in the upcoming Lok Sabha elections. Amanna Inamdar caught up with technology-focused lawyer Vinay Kesri to get to the root of the issue. Listen in.
It's a bit strange that that the CEO of Twitter has been summoned in the first place. But apart from that, I think there's also a lot of lack of clarity about what exactly this hearing was supposed to be about. There's very little information available. The correspondence between the committee and Twitter is, of course, not public as far as I'm aware. So I don't know exactly what is there. But as far as the general public is concerned, we know very little about why they want to summon the CEO of Twitter and so on. The motivations are a little opaque at this point, and I'm not really sure what interest of democracy is being served by all of this.
Vinay, the question also is, you're right, there is no clarity on why Twitter is being served. The official reason, which Anurag Thakur has put out on his Twitter handle as well, ironically, is to safeguard citizens' rights. But you have to see the sequence of events that we have seen, which started with protests by people outside the Twitter India office saying that those who support the government and have a right-wing ideology are being targeted by Twitter. Their accounts are being shut down. They're not being verified, etc., etc. Then there is this organization that writes a letter to this parliamentary committee complaining about Twitter, and then this summons goes out. So linking that sequence of events, one comes to the conclusion that that is the real grievance, that why are people with a certain ideology being shut down? And then now let's look at it in the context of how social media giants have been very wary after being accused of influencing elections, over time. So do you think that this could be a case of a political position being pushed through this parliamentary panel, and that is why there's so much skepticism about the summons?
See, it's hard for me to comment on exactly what the motivations could be at this point, because again, in the absence of some actual content in terms of what they wish to explore during this hearing and so on, it's pure guesswork as to what the chain of events is that led up to this. What are the possible motivations? To be honest, anything is possible. And going back to a point which perhaps I think Raman was trying to make as well. See, it's a good thing for parliamentary committees to actually try to do their job and to hold the executive accountable and to inquire into issues that actually matter to our democracy. But I think the real question we should all be asking is this really a fit case to exercise these powers?
That's a wrap on this edition of Power Lunch. Thanks so much for watching.